Hello and welcome back, guys, in this another session of SPR's exam kit. So today we'll be discussing about Marchant, which is question number 11. Okay, so what we've been given is that Marchant is a public limited company and it has several investments. Okay, so that's the parent, and then that's the subsidiary, and that's the associate or something else. We'll have to look at it as well. Okay, so three companies are there. This is the parent, and this two are the investments. Okay, so we've been given revenue, COS, other income, administrative cost, other expenses, finance cost, income, finance income, income tax expense, and then other comprehensive income, right? So what else are we given? So what we've been given is that the following information is relevant to the preparation of group statement of SOPL and OCI. So all of this is relevant. Okay. So on May 20x2, March acquired 60% of the equity interest of Nathan, a public limited company. The purchase consideration comprised cash of 80 million and the fair value of the net assets acquired was 110 million. The fair value of the NCI was 45 million on May 1st, right? So that means exactly 1 year ago. What's our closing date? 20x4, right? So that means exactly 1 year ago. Okay, exactly 2 years ago. Yeah. And then share capital was this much, return earning was this much, other component of equity was this much. So there was an excess fair value as well. Fair value adjustment is there for non-depreciable land, so no need to worry about depreciation. So that would have basically hit our cost of sales as well, because it would increase our depreciation rate, right? Which is not the case. And then the goodwill has been impaired annually as at 30th April 20x3, but we are preparing only for 30th April 20x4, right? So we don't need to worry about this impairment. However, at 30th April 20x4, the impairment of the goodwill has been reversed and the goodwill was valued at 2 million above its original value. Okay, so where will this basically hit is that it will be charged as other expenses, right? So what this will basically do is that it will increase our because goodwill cannot be reversed, so we don't need to worry about it much, but it will still increase our other expenses. Okay, and then so Marchant had 60%, right? So now they are disposing of 8%, so that means 52% will still be there. So that means it has not lost control. That means it's not a significant event, it's just a transaction between the shareholders. Okay, that's how we treat when the control is not yet lost. So that will basically be in cash consideration of 18 million and had accounted for the gain or loss in other income. The carrying amount of the net assets of Nathan at 30th April 20x4 was 120 million before any adjustment on consolidation. Okay, so what should be adjusted for is that the fair value gain, right? And then we'll see any other adjustment might be needed or not. And Marchant accounts for investment in subsidiary using IFRS 9 financial instruments and has made an election to show gain or loss in other comprehensive income. This is not valid. You can't do this. Okay. So it will be presented in SOPL directly at the top. Okay. It will be basically profit on disposal of subsidiary or loss. Okay. And the carrying amount of the investment in Nathan was 90 and then 95 million as at this time period. So Nathan acquired 60% of the equity interest of option. So now it's a subsidiary. You'll have to consolidate it. So when did it acquire? On 30th April 20x4. Okay, and then the purchase consideration was this, and then net assets identifiable at the date was this, and then 1st November 20x3. So we are preparing for x4, right? 30th April 20x4. That means we will need to consolidate it for how many months? April, right? May, June, July, August, September, October, November. Or do we need to for May as well or not? Let's see. April, right? May. So November, December, January, February, March, April. Okay, so 6 months, yeah. So 6 month we will consolidate it, okay? And then identify net assets was this much, fair value of NCI was this much. Okay, easy. It's already been given. We don't need to calculate it. See, net identifiable assets of, net assets at disposal is given. NCI is also given. So what we do is goodwill plus net assets at disposal minus NCI at disposal, right? Which is already been given. Good. The remaining equity interest was fair valued at 40 million, right? Okay, good. After the disposal, Marchant exerts significant influence. Okay, so even though it is less than 20%, only 20%, it exerts significant influence. When will it have a significant influence? If it provides technical service, or if it has a bigger, huge transaction with the company, or in the case of if it is likely to represent the board and make decisions, or if it is going to represent the board, and then if it is likely to shape the operating and financial policy of the company. Okay, and then if the key management personnel are from the parent, then it will have a significant influence. Okay, always remember this criteria. Any increase in net assets since acquisition has been reported in SOPL. Okay, it's already been recorded. Good. The carrying amount of the investment in option had not changed since acquisition. Okay, so carrying amount of the investment in option had not changed. Otherwise, if there was any change, any gain or losses will be credited towards SOPL, right? And goodwill had been impairment tested. No impairment was required. Okay, good. No entries had been made in financial statement of Marchant for the transaction other than for cash received. So what they did was basically they only recorded cash received, right? Of how much? Of 50 million, right? And then Marchant sold inventory to Nathan. That means parent sold it to subsidiary, right? Whereas this option is now associate, right? After the middle of the year, it's already been it's sold its stake of 40%, so it's now associate because it has significant influence. Marchant made a loss on the transaction of 2 million. Okay, so there was a loss. Sold inventory to 12 million, right? So what it did was it basically did debit receivables, credit revenue. That's what it did, right? So we need to eliminate this from this is intra-group transaction, right? So Nathan still holds 8 million of this inventory at the year end. Okay, that's for PORP. But we are only required to prepare SOPL, right? No need to worry about that. So what are we required to prepare? Prepare a consolidated financial statement of SOPL and OCI for the year ended 30th April 20x4. Okay, and explain with suitable calculations how the sale of 8% equity in Nathan should be dealt with in the group statement of SOFP at 30th April 20x4. Okay, so let's prepare our consolidated financial statement. Okay, consolidated SOPL statement of profit or loss and other comprehensive income for the year ended 30th April 20x4, right? April 20x4. Sorry. So first thing first, revenue. Revenue COS let's leave this much line. Okay, so revenue will be 400 plus 115, right? 400 plus 115, 400 plus 115, and then plus how much will this be? So November, right? So November, December, January, February, March, April. So 6 months, right? May, June, July, August, September, October, right? So 6 months, yeah. So it will be consolidated for 6 months, and then revenue is 70. So 70 into 6 divided by 12, right? Minus any intra-group transaction. Yep, Marchant sold goods to Nathan, right? So that's what we need to subtract for 12 million, right? 12, okay. So once that's done, SOPL as well, it will be pretty much same. 312, 65 and 36. 312 plus 65 plus 36, right? Plus 36. 36 into 6 divided by 12 plus what else? It will be not this, minus any PRP at 12, right? Same figure. So this minus this will give us our gross profit. What else is there? Other income. 21,700. Other income, right? So what will be other income? They're working note side by side as well. Okay, in case of subsidiary the holding is, and in case of associate the holding is. So what's the holding percentage? 60, right? No, it is 60 and 40. Okay, so 60 and 40 remains the same. This will be, now this will also change. This will be 52, right? Because it sells it. So 60 minus 8. Yes. Percentage 52. And what about this?